stocks this week. Infosys cuts its revenue guidance for the year, while TCS reports a better than expected first quarter result. We will tell you what this means for your technology stocks. The HDFC twins report earnings in line with expectations. We'll find out what this means for the banking sector. And Paras Edenwala picks Mayur Uniquoters as a smart investment option for you. We're going to find out why. Welcome to All About Stocks. You're watching ET Now. As we begin a new earnings season, remember this is a show that will put those numbers into perspective for you and tell you how to use the numbers to better your stock portfolio. At the same time, we'll continue answering all the questions you send us on email and on our Facebook page. That email ID is at the bottom of your screen right now. So before I bring in my big guest this week to explain to us what the new numbers of this quarter mean for us, Avan is here with the latest on the markets and, of course, that IIP number. Avan.
We welcome the earnings week with the Nifty snapping its 5-week winning streak. So for the entire week, the Nifty shaved off close to 1.7%, as did the Sensex. Not too much respite for the broader markets, which were down by 1% apiece. Obviously, the big losers came in from the IT pack, so Infosys was down close to 8% for the entire week, dragging down Wipro with it. On the gaining side, it was the monolith from the oil and gas space, ONGC, which held up, as did GAIL India. There was big news in the commodity space, so financial technologies and MCXSX were in focus as SEBI gave the nod to MCXSX in order to start its equity trading platform, and it will be launching currency options within a month. Banking sector was also in focus. We had exclusive news that SBI, the bank's Q1 NPAs are likely to be at 4,500 crore rupees according to sources, and they do see about 3,000 crore rupees of their loans being restructured in the first quarter. Did go down well with the stock. SKS also worries looming large when it comes to its earnings. The Q1 operational cost is expected to be higher than 30 to 50 crore rupees, and FY13 is likely to be rather adverse in terms of its financial performance. In terms of macroeconomic data, you had the IIP numbers, which came in higher than the street estimates at 2.4% for the first quarter, largely driven by manufacturing growth. The capital goods, though, that slumped by close to 7.7% and continues to remain weak. You have most of the experts who believe that the May IIP numbers builds a stronger case now for the central bank to keep the policy rates unchanged in its review later this month.
Right, I'm going to ask Paras Edenwala in a little while if that May IIP number means actually that we've bottomed out and it's going to start looking better from here on. But Avan, give us the big earnings of the week as well. We saw very interesting numbers come out of the IT sector. Take us through it.
A bit of a mixed bag when it came to the earnings season. We'll start off with the first company that reported its numbers. That was an HDFC, and a fairly stellar quarter. You had the Q4 profits, which were higher by 19% at 1,001 crore rupees, while the net interest income was higher by 19% at 1,565 crore rupees. From the banking arena, then we had HDFC Bank, which also put out its numbers. The first quarter net profit soared over 30%, backed by strong loan growth, as well as a big jump in its fee income and commissions. The net interest income, too, for the bank saw 22% at 3,500 crore rupees. The results also saw the stock price gaining good trajectory and was largely in line with estimates. But it was the IT pack that was in focus, and IT bellwether Infosys clearly disappointed the street yet again with its quarterly performance. The stock, in fact, tanked on the back of that news, and the company cut the revenue guidance this time around for the financial year to 5% vis-a-vis the earlier estimates of 8 to 10%. The quarterly profits also were below the street estimates. The Q4 PAT was down 1% at 2,289 crore rupees. The management continued to maintain that the economic environment continues to remain tough. Most of the brokerages believe that now the guidance has lost its credibility and other IT companies will continue to face growth issues. TCS, on the other hand, went on to rub salt in the wounds of Infosys and came out with a stellar set of numbers. You had the Q1 profits, which were higher by 11% on a quarterly basis at 3,318 crore rupees. Net sales also witnessed an uptick to the tune of 11%, coming in at 14,870 crores. But all in all, the results were certainly in line with estimates. And on all parameters, you had TCS, which went on to beat Infosys, while the street gave it a good thumbs up, and brokerages, too, are largely positive on this stock.
Thanks, Avan, for those numbers. Joining us now to help us understand those numbers is Jagdish Malkani, member of the BSE and the NSE. Jagdish, Thank you so much for spending time with us on All About Stocks. I want to talk to you about Infosys. We saw those disappointing numbers. We also know that a lot of analysts are now of the opinion that Infosys is not even going to be able to make that 5% growth that is forecast for the rest of the year. Now, in your opinion, do you think that forecast is looking a little stretched?
Yeah, I would think so. I mean, obviously, they must have been expecting a lot of slack, which has come. And I would imagine, I mean, when I say expecting so, it's a very unstable and volatile environment, to say the very least, as has been enunciated by the management. But having said all that, clearly the company has, somewhat lost its way in the last few quarters. And some of the old principles of, top management being passed on, especially the CEO, etc., being restricted to the founders. Many issues, I think, even on pricing, on the way they handle their cash pile. Especially the contrast could be more stark when the same day you had TCS coming out with pretty stellar numbers, continuing a blazing performance of the last few quarters.
And what's your reaction to the company's decision to discontinue guidance every quarter as of now?
I think it's probably prudent now with all the bad news to even take this on the chin with no guidance, etc. But let's face it, what they are talking about is pretty disappointing, and not even meeting the NASSCOM guidance for the whole industry, etc.
I also want to understand from you what your advice is to investors who have Infosys shares in their portfolio. A lot of retail investors have held the stock now for a very long time. What would be your advice going forward?
Well, for the braver ones, it may not be a bad idea to take it on the chin and flip it into the leader, into TCS, ideally on a dip. And otherwise, the other one which I think will do well in the big pack, which is cheaper, is HCL Tech, but then doesn't enjoy that credibility. In these uncertain times, better be with a leader, and TCS is walking the talk. The last few quarters have been really stellar.
Right, Jagdish, but it's important for us to understand that some time ago, every retail investor felt the need to have an IT company, a big IT company, as part of their portfolios, to be part of that big move that we saw in the last maybe 10 or the last 7 years. Do you think now there is still value within that IT sector? Do you think retail investors should still have a big IT company as part of their portfolio?
In any reasonable Indian portfolio, you would need to have IT, and in IT, you need to have one of the big five, I would say. And TCS, being the leader, you can't buy Accenture, you can't buy Cognizant. Is a pretty good story. The concentration should be on the biggies where you can go to sleep knowing that nothing major is going to shake the boat. Whereas in a mid-cap, any news related or whatever they may say, unless you're in the niche of the business, you can be swamped. There's major consolidation happening in the IT sector.
I also want to talk to you about HDFC Limited and HDFC Bank. HDFC Limited first. Both of them looking really stable, but there has been a small increase in the non-performing loans. Do you see this as something that will cause concern in the future?
HDFC Limited, of course, in housing finance. I mean, if you're really looking for splitting hairs, one can. But otherwise, by and large, very steady performance. The NPLs are minuscule compared to the scale of the business they do, the way they are getting into smaller towns, etc., making up for the difficulties in tough markets like Mumbai, etc. HDFC Bank, again, blistering performance, boringly, predictable, 30%. Just by repeating their formula, they're going into the tier 2, tier 3 towns, steering clear is remarkable of all the troubled sectors that afflict other banks.
Is this a clue as to what we can expect from the rest of the banking pack?
Top quality private sector banks, yeah, it bodes reasonably well. I mean, banks that aspire like HDFC, like Kotak Bank, I'm sure will put in a robust performance. Yes Bank on a smaller level, and some of the South one. I'm talking the private sector banks pack. Karur Vysya, maybe ING Vysya, the MNC pack. South India Bank. Yeah, so it should be pretty good performance, maybe even a DCB next week. But PSU banks is another story. They are going to be saddled, and more so you saw the State Bank announcement with there's more pain ahead. Corporate India is hurting. There's no reason why the banking sector in general and especially PSU banks will not be hit.
All right, and last question very quickly, Jagdish. At current valuations between HDFC Limited and LIC Housing Finance, which one would you prefer?
LIC Housing Finance is not bad, but as I said, with property hurting, etc., see the quality of management of the lender becomes extremely important. So yeah, the valuation it's not bad, I would say, but after its problems a couple of years ago on management, etc., it seems to have got over that. They were unfairly punished with strictures, etc. So I would still stick with as I said, in these uncertain times, stick with the predictable. So HDFC Limited, it's not going to give you some heady return, but at least you can sleep easy. And in the small gallery on a dip, again, it's subsidiary, 63% subsidiary. GRA is a good one. But LIC Housing on a dip is not bad.
All right, HDFC Limited is Jagdish's pick this week. Thank you so much for joining us, Jagdish. It's always a pleasure to have you on this show. On the other side of this break, Paras Hedenwala joins us to give us his stock recommendation this week. We'll find out what his recommendations are and where you should be putting your money. That's on the other side. Don't go ahead.